Understanding capital expenditure versus revenue expenditure for corporate tax purposes. When determining the taxable income of a business for corporate tax purposes, it is essential to understand the difference between capital expenditure and revenue expenditure. These two types of expenditure are treated differently in tax accounting, and it is important for businesses to properly classify their expenditures to ensure compliance with tax regulations. 1. What is capital expenditure? Capital expenditure refers to money spent by a business to acquire, upgrade, or maintain physical assets that will provide enduring benefits over time. These assets are expected to contribute to the business's operations for multiple years and are typically long-term investments. Capital expenditure is not directly deductible when calculating taxable income for corporate tax purposes. Capital expenditures create or enhance assets that will provide benefits over the long term. Examples of capital assets include buildings, machinery, computers, and vehicles. Because these assets have long-term value, businesses are not allowed to deduct the full cost of these assets in the year the expenditure is incurred. Instead, businesses recover the cost of capital assets over time through depreciation or amortization, depending on the nature of the asset. 2. What is revenue expenditure? In contrast to capital expenditure, revenue expenditure refers to the costs incurred in the day-to-day operations of the business. These expenses are typically short-term in nature and are fully deductible when calculating taxable income. Revenue expenditure includes costs like salaries, office supplies, rent, utilities, and routine maintenance of assets. Revenue expenditure does not create long-term benefits, and it is typically associated with the ongoing running of the business. Unlike capital expenditure, which is related to acquiring or improving assets, revenue expenditure is incurred to maintain the business's current operations. 3. The key difference between capital and revenue expenditure. The primary distinction between capital and revenue expenditure lies in the enduring benefit. Capital expenditure creates or enhances assets that will benefit the business for several years, while revenue expenditure supports the business's daily operations without providing long-term benefits. For example, the purchase of machinery is a capital expenditure because it creates an asset that will benefit the business over time. On the other hand, paying for routine maintenance of that machinery is a revenue expenditure because the cost is directly related to keeping the machinery running, but it does not create a long-term asset. 4. Depreciation of capital assets. While capital expenditure itself is not deductible for corporate tax purposes, the depreciation of capital assets is deductible. Depreciation is an accounting method that spreads the cost of a long-term asset over its useful life, reflecting the asset's gradual reduction in value as it is used in the business. Even though no cash payment is made at the time depreciation is recognized, businesses are allowed to deduct a portion of the asset's cost each year through depreciation. This provides a tax benefit to businesses by reducing their taxable income over the life of the asset. The depreciation expense is calculated based on the useful life of the asset and is deducted annually. 5. Capital or revenue expenditure, the case of a car purchase. Let's consider the example of a building contractor who buys a car for use by office staff. The car will be used in the business for a number of years, providing an enduring benefit to the business. As a result, the expenditure incurred to acquire this vehicle would be treated as capital expenditure, and therefore not deductible for corporate tax purposes in the year it is purchased. However, the costs of maintaining this car, such as fuel, insurance, and regular repairs, would be considered revenue expenditure. These costs do not provide long-term benefits or create a capital asset. Instead, they are incurred to maintain the car's current functionality and are deductible for tax purposes. Now, let's consider a different scenario. If the same car is purchased by a car dealership for resale, the expenditure would be treated as revenue expenditure. This is because the car is intended for resale, making it more akin to inventory. In this case, the cost of purchasing the vehicle is directly related to the business's operations of selling cars, and thus it is deductible as revenue expenditure. 6. Capital or revenue expenditure, the case of a computer purchase. In another example, let's consider a cake shop that buys a computer for use by office staff. The computer has an expected useful economic life of 5 years. The initial expenditure for purchasing this computer will likely be treated as capital expenditure because it will provide enduring benefit to the business over the 5-year period. The cost of purchasing the computer will not be deductible for corporate tax purposes in the year it is bought. However, the cake shop will be able to recover this cost over time through depreciation. If the business recognizes a depreciation expense over the computer's useful life, the expenditure will become deductible for tax purposes, in proportion to the depreciation expense recognized each year. This allows the cake shop to deduct the cost of the computer gradually, in line with its usage and value reduction.